Hi, Kamusta? How is your business or school studies? Thank you for your time and visit. Are you working on an assignment? Preparing for a recitation? Reviewing for an examination? Or advancing a lesson? Learn certain fundamentals of accounting for your school or business. This video about the accounting equation and transaction analysis is right for you. This is lesson 3 and part of a series of videos to help you master the fundamentals of accounting. Ready to focus on our topic? The balancing procedures for the popular accounting equation are pretty basic and straightforward. If you have watched video lessons 1 and 2, you will easily get the analysis in this lesson. Here we go. Ready? Alright, coming up. Let us take a look at the basic accounting equation and check how each business transaction is affecting it. Remember, at any given date and for any kind of valid business transactions, the two sides should always equal. Here are simple rules to remember to maintain the equality of the accounting equation. First, at least 2 accounts should be plotted. It could be more than 2 accounts, but it should never be just one account. Second, pay attention to the basic addition and deduction on the two sides. An addition to just one side or element is not correct. Or a deduction to only one side or element of the equation is also not correct. These are also not correct and will bring the equation imbalance, 2 or more additions on just one side or element. Or 2 or more deductions on just one side or element. Also watch out for these errors on addition and deductions, addition on one side and deduction on the other side. Or vice versa, deduction on one side and addition on the other side. Alright, having identified some of the possible sources of the errors that make the equation not equal, let us also identify the elementary principles that will make it equal. They are, addition on both sides, deduction on both sides, or addition and deduction on a single side. We also have a combination of addition and deduction on a single side coupled with addition on another side. And so many other possible and logical combinations. Please take note, in our transactional analysis ahead, we shall be stating no effect, in cases where a particular transaction does not affect an accounting element. With those as guide, let us proceed to some examples, first between assets and liabilities. When cash funds are borrowed from a bank to finance the business, that is an addition to assets and liabilities. Once the loan is paid back either in full or partial, that will be a deduction to assets and liabilities. Let's do more dual effects. Supposing a car for the business was purchased from a friend on account, meaning the payment is not yet at this point. That is an addition to assets and again on liabilities. Check this time between assets and capital or equity relationship. Supposing the owner invested cash into the business, that will be an addition to assets as well as on the capital. Or the owner transferred computers and other machines for office use, that will again be an addition to assets and capital. What if the owner took some office supplies for home use? Well, that is simply a deduction to asset and capital. Are you getting it now? Is the basic equality requirement of the equation coming clear to your mind? You are awesome! Of course, you are asking, dude, what about liabilities and capital? Well, let us cover that for you. The relationship between liabilities and capital should be the opposite. Look at this one. Supposing the business borrowed cash from a bank, but then, the owner directly collected and diverted the amount for home repairs. The effect in the accounting equation should be an addition to liabilities, and a deduction to capital. Reversing the scenario, supposing the owner paid the bank loan liability of the business, but instead of using the business cash, the owner paid it with personal cash. That will be a deduction from liability and an addition of capital. For transactions affecting one element only, say assets only, an example includes a purchase of land for cash. The purchase of land is an addition to assets, and the payment for it in cash is a deduction on assets. Another is a sale of a building for cash. The receipt of cash is an addition to assets, and the sale of a building is a deduction on assets. Moving to liabilities only. An example of this is an account payable being transferred to notes payable. The transfer increases and decreases liability by the same amount. For the capital element of a sole proprietorship, there is rare chance that a transaction would affect it solely. Moving on. What about transactions that affect the three elements? Alright, let's have some. The business owner paid the loans payable including interest on it. The payment will have assets deducted by the payment of principal amount plus interest. The liability will be deducted by the amount of loans payable, and the capital will be deducted due to the interest expense. Let's have one more that has an effect on all three elements. A mortgaged land including its liability, is transferred by the owner as an additional investment into the business. The land will be an addition to assets, the mortgage payable will be an addition to liabilities, and the difference between the two will be an addition to capital. Let's try few more, this time on expenses and revenues. Prepaid rent previously recorded has expired. The expired prepaid rent will be a deduction on assets, while the rent expense will be a deduction on capital. Another is on utilities expense that has already been incurred or used but is not yet paid. The unpaid utilities used will be an addition to liabilities, and the utilities expense will be a deduction from capital. Shifting to revenues this time, a client for example, is billed for services that is already completed. This will be an addition to assets in the form of accounts receivable and an addition to capital in the form of service income. Another is on an unearned income, that was previously been collected has now been earned. The earned portion of the unearned income will be a deduction from liability, and the service income that has been earned will be an addition to capital. Before we resume on another case of transactional analysis, here's some quick help guide based on what we have just accomplished. Always remember, expenses used, whether paid or not, should decrease capital, owner's drawings of any kind of assets should also decrease it, and revenues earned, whether received in cash or not yet should increase the capital. Needless to say, additional investment, normally, should increase assets, as well as capital. With that as guidance, we shall have the expanded accounting equation which shall become basis to further our transactional analysis. To level up our transactional analysis and to improve our balancing skills, it is time to include amounts in our examples, making our equality drill realistic. Ready for this? Alright, coming up, here are the transactions. There they are. There are 20 transactions to help in our balancing equality drill. Let us produce a transaction table to start our analysis. The table is color-coded between assets accounts, liability accounts, and capital accounts to help us visualize the flow of transactions analysis. Also provided below is the equation field to help us monitor whether the balances are in equality. All is set up and ready. Let us proceed to the first transaction. The $50,000 business loan from a bank will be an addition to the cash in the assets section. In order to balance the equation, we must also place the same amount under a loans payable in the liability section as an addition. As a result of properly plotting the transaction, the two sides of the equation are in equality. Always remember, at least two accounts should be plotted to balance the equation. At times, it could be more, but it can never be just one account. Let's bring in the second transaction. The $30,000 purchase of car will be an addition to transportation equipment under the assets. It says on account, meaning not yet paid, so there is also an addition accounts payable in the liability section. Total assets now is $80,000, and so with total liabilities, which makes the two sides in equal amounts. Marching forward to the third line transaction, the transfer of equipment from the owner's possession to office use will be an addition to assets under office equipment, and to counter the increase on that side, the capital section will have addition for the owner's investment of equipment. Moving to the fourth line transaction, a purchase by the business of $1,000 worth of office supplies will reduce cash in the asset section. But then, the asset account office supplies will increase by the same amount. This is what is called transfer of one asset to another asset. While the other side is not affected, the equation will remain balanced and their totals remain unchanged. Observe too, that whenever a decrease is effected, we shall be using a close and open parenthesis to signify the deduction. Are you enjoying the learning process? Learning Spaces community is grateful for having you as one of its subscribers. Welcome to Learning Spaces community. Now for the fifth line transaction, the $15,000 receipt for services completed will increase cash in the asset section. Since this is a revenue account, it will be a direct increase in the owner's capital. The office supplies taken for home use on the sixth transaction amounting to $200 will have the office supplies decreased by that amount. Any personal use of assets by business owners is always treated as a reduction of the owner's capital. Plotting the seventh transaction line, an unearned revenue, is a liability account. This is not an income yet, so it will not affect the capital. The collection will have cash increased on the asset section by $30,000, and since it is a liability, the unearned income in the liability section will be increased by the same amount. Advancing to the eighth transaction, payment of expenses, since the $5,000 is paid in cash, it will be a deduction on cash under the assets section. On the other side, it will be a direct deduction of owner's equity by the same amount. Here comes transaction line number 9. The additional investment of land will increase the asset section by $100,000 for the land. The capital on the other section will also increase by the same amount as a result of the investment. For the mortgage liability on the land, which is also being transferred into the business, the liability section will have an addition of $50,000 on mortgages payable account. And because that is the owner's liability, but is now being transferred into the business, the capital will be reduced by $50,000 as well. Halfway through our transactional analysis, let us load number 11. The partial payment of bank loan along with the interest expense on it. This transaction will decrease cash on the asset section by a total of $5,100 pertaining to the loan and the interest. To balance the equation, the loans payable on the other side will decrease by $5,000, but the $100 being an interest expense will be a deduction on the capital. Moving down to transaction line number 12. The earned portion of the unearned income will be a decrease in the liability section by $4,000. To counter the decrease in liability, the capital, which on the same side of the equation as the liability, must be increased by the same amount. Why is it being added? Well, that portion is already earned. As we were saying loudly, all income should be an addition to capital. Developing to transaction 13. the sending of a bill, or a reminder on an amount that is due from a client for services rendered. This will increase the accounts receivable by $3,000 on the asset side. Since the service income is already rendered, the capital will also increase by the same amount. Now on financial transaction line 14. Expenses incurred that are not yet paid will fall as accrued liabilities. So, the liability section will increase by $4,000. The expenses incurred will then decrease capital by the same amount. Why? Well, as we were shouting loudly, all expenses, whether paid or not, should decrease capital. Progressing to number 15. This is another case of an asset being transformed into another asset. Cash is decreased by $1,000 as payment for office equipment, which is increased by the same amount. This event does not change the equation at all. Farther down to number 16. The payment of a bank loan will decrease the loans payable by $5,000. But since the money that was used to pay it, including the interest of $100, is the owner's own cash, the capital will increase by $5,100. For the interest expense of $100, the capital shall decrease by that amount. 3 more and we're done with our transactional case analysis. By the way, the next lesson after this transaction analysis is journalizing and posting. See you soon in that lesson. Let's look at how number 17 affects the equation. The collection of receivable by the owner will decrease it by $3,000. But, since the amount is directed by the owner for personal home use, the capital should be decreased by that amount. Now for transaction number 18. The sale of office equipment worth $2,000 will increase cash by $1,000 and accounts receivable for the other half, which is also $1,000. The office equipment itself will decrease, of course, by $2,000. Again, this is an example of an asset being transferred to other forms of assets. Proceeding to the second before the last item, for number 19, accounts receivable, shall be cancelled or is decreased by $1,000 as a result of it being transferred to notes receivable, which shall increase by the same amount. Again, this kind of transaction will not affect the entire accounting equation. And now finally, down to the last transaction. The collection of the promissory note including the interest on it, will have cash increased by a total of $1,020. To balance the equation, the notes receivable should now be reduced by $1,000, and the interest income of $20 shall appear in the capital section as an addition. After correctly plotting all transactions into the table, bring down the final balances of all accounts. The total of all asset accounts must be equal to the total of all liabilities and capital accounts. In cases where the totals do not tally, do not panic. Simply recheck where the errors might have been. Congratulations for completing the drill on transactional analysis. Keep watching it back and forth to master it. With the basic skills and understanding you have just acquired regarding the accounting equation, you are now ready to proceed to the next lesson, which is journalizing and posting of business transactions. The lesson that you have just learned is enough to get you a high score in your recitation, or quiz, about transactional case analysis and accounting equation. If you need more review materials on this topic to validate your knowledge and understanding, check the description field below, or join the membership and get review questionnaires related or specific to transactional analysis and accounting equation. Once a member, you will have access to other questionnaires on various lessons as well. Continue learning. We have lots of free lessons on to help you master the foundation of accounting. Thank you for learning with us and see you in another accounting course lesson. Also check the description field below for links on online materials, books, exam reviewers, quiz materials, and more. Palam sa inyo. Goodbye for now.